Good morning, everyone, and thank you for dialing in today. As we've got a few people registered, we'll wait just a moment or two just to allow everyone to join and get comfortable before we begin. Okay, so we've got most people who've already joined. Good morning, my name is Haifa and I'm a marketing assistant here at InfoTrack. Welcome to today's webinar where we'll hear about the most relevant SDLT changes for the remainder of 2022 and beyond, focusing on the most important changes to stamp duty that law firms need to know about. Taking you through today's webinar, I'm delighted to be joined by self-described stamp duty guru, Sean Randall. And before we begin the webinar, I would like to draw your attention to the Q&A tab, which is located at the bottom of your screen. We will be running a Q&A at the end of this session, so please type any questions that you might have for Sean, along with your name, into the Q&A box. That way, if we run out of time or if your question requires further clarification, we can extract your information and follow up with you directly after the webinar. I'll now hand you over to Sean. Thank you.
Thanks, Haifa. Good morning, everyone. Haifa. Okay, brilliant. So I'll share my screen now. Okay, that should work. So good morning. Thanks very much for joining us, and I hope you're doing well. I'm going to talk to you for about half an hour. That's my intention, at least, covering a few topics which I think are relevant, and there'll be time for some Q&A, as Haifa mentioned. So do take advantage of that opportunity and post some difficult questions for me. So my contact details are there if you don't know me. If you want to follow up and ask any questions, I'd be delighted to help. Okay, so what are we going to cover? I thought we would cover, firstly, the imminent changes likely to mixed use and multiple dwellings relief. I think they're probably the most important changes to residential property transactions for a long time, and we'll talk to what that might look like and when they might come in. Then bring you up to date with some recent cases, those which are relevant at least to your area, before moving on to a new relief for stamp duty, land tax and ATED, the annual tax on envelope dwellings for the Homes for Ukraine scheme. And then finally, I put caveat emptor, which is a warning for you on some things which I've seen in the marketplace. Okay, let's look at MDR, multiple dwellings relief and mixed use. So I've spoken about this before. I don't intend to cover exactly what I think the new changes will be. You can look at the consultation document, which is still available online. If you Google consultation, mixed use, multiple dwellings relief, stamp duty, you ought to find it. But suffice, I'll cover in broad detail what the changes are likely to be. But the main thing to talk to is timing. Now, these changes are almost inevitable in my view. They're very likely to come in. The only question is when and what they will look like. So we have some kind of fiscal event, whether it's a mini budget or some kind of financial statement. It is scheduled to happen on Friday this week. I think the better view is that no changes are likely to take effect from that day. So although there may be some mention of this, I think it's very unlikely that there would be, but there may be some mention of this. If there is, it's probably merely a mention and a renewal of their commitment to introduce changes. What's more likely, I think, is that these changes will be announced whenever we have the real budget, the proper autumn budget, which probably looks likely for back end of October. possibly early November, and we ought to get more detail as and when Parliament comes back after the recess. But at this stage, there is no firm date for timing of that budget. There is, though, talk in the consultation document of a commitment to consult on draft legislation, and that might mean, therefore, that these changes, when they're announced, won't take effect immediately, and therefore there will be an opportunity to understand what they mean before they do come into effect. And that might mean, therefore, that draft legislation is published for consultation in the autumn, and with a view to enacting it in next year's Finance Act, as and when in the early summer, perhaps next year. So keep an eye on this space in particular, and to the extent that you're taking on clients now with mixed use or MDR being a feature of the transaction or a potential feature, then do bear in mind the possibility that these changes may affect the transaction if they don't complete at some point imminently, perhaps late October. Okay, let's look at mixed use. So, I mean, really to recap, because I've spoken about this before, we have two alternative sets of rates in the main, one for exclusively residential property transactions, and that can be subdivided into standard rates or higher rates. And then we have another set of rates which applies to mixed use or non-residential transactions. So that set of rates, the 0% to 5% set of rates, applies where literally, to any extent, the transaction or a linked transaction even includes property that is not residential property from an SDLT perspective. So this is an all or nothing or hard-edged rule to any extent. If the property or properties includes non-residential property or non-residential use, then those rates are engaged on all of the purchase price and all of the consideration. There's no apportionment at this stage where you cut up, if you like, the price between that which is attributable to the residential component and that which isn't, taxing both sets or both elements at different sets of rates. That doesn't apply. And equally, there is no de minimis. So there is no minimum percentage of the non-residential property of the total purchase price before these non-residential or mixed rates apply. And one of those two things, or possibly both, is likely to come in soon. So this hard-edged rule is likely to be replaced by an apportionment rule or possibly a de minimis threshold rule. And it's even possible that there might be an alternative or a hybrid where, let's say, you apportion the price between the residential and the non-residential elements of the price, except where the non-residential element is over 50%, and where it's over 50% possibly, then the table B rates, the non-residential mixed rates, apply to all of the price. So there might be some kind of hybrid solution. Okay, what will it mean? Well, it definitely will mean the end of arguments, boundary pushing arguments, I call it. So arguments which are very, very close, if not over the line, in terms of being untenable, in an attempt to engage those table B rates. And even where you have a genuine mixed use transaction, possibly where there's a farmhouse being sold with land which isn't grounds of the house and serves another function, perhaps some agricultural land, or land which is, I don't know, occupied by a third party in the course of their trade, where you have those types of genuine mixed use transactions, well, in some cases, the SDLT payable will double. So particularly for transactions, I don't know, above 2, 3, 4 million, there will be a significant impact. And that might mean once these changes are trailed, that will hit the market and there may be a bit of a rush for that type of transaction. But as I mentioned before, these changes are likely to be indiscriminate. So they will affect, in inverted commas, genuine mixed portfolios and genuine mixed use buildings, as well as transactions where the argument that there is non-residential use is much more debatable, put it that way. It might mean that there is more pressure to value the non-residential element of the price, or the non-residential element of the property, I should say, particularly if there's a threshold, because there'll be enormous pressure to try to argue that you're above a particular threshold. There is also, buried in the consultation document, maybe that's a bit of an exaggeration, but there is definitely a commitment in the consultation document to switch on the surcharge for mixed use transactions where multiple dwellings relief is claimed. And at the moment, that isn't the case. So if you claim multiple dwellings relief on a mixed use transaction, you don't take into account the higher rates when you calculate the MDR or the SDLT chargeable in accordance with MDR. And that will in particular affect, build to rent developers or investors, perhaps buying in a forward funded deal where the development isn't complete and but nevertheless it's in progress. Perhaps it's at golden brick, and therefore the price spread between the number of units which are to be built is very low on an average basis. And at the moment, therefore, they can really take advantage of lower tax rates, but will pick up that 3% surcharge in the future. However, the rule that says the purchase of more than 5 or 6 or more dwellings in a single transaction is treated as if they were non-residential, that is likely to be unaffected entirely. So again, to the extent that you're buying a building that's composed of 6 studios, for example, or 6 separate dwellings situated around England and Northern Ireland, then that 6 or more rule really will shelter a lot of stamp duty that would otherwise be payable. And it might encourage, at the higher end, might encourage people, in fact, I've seen evidence of this already, people deliberately buying more properties, try to get within that particular rule in order to pay less SDLT, which would compensate them for buying more properties. So if you're already buying 3 properties, for example, in a prime or super prime development, well, there'll be pressure on buying another 3. Okay, MDR. So this one is much more specific in its effect, I think. And in particular, it's likely to bring to a close a practice that emerged when, 2017 probably, of claiming this relief on annexes. And at the moment, it's worth a maximum of around about £86,000 for a single annex. So it is certainly a material saving for higher end transactions in particular. And the likely change is to align the rule to a concept that applies to higher rates. That is, that a dwelling that is in the same building or on the same grounds as another dwelling is disregarded for the purpose of the higher rates, the surcharge, if the price payable or attributable to that dwelling is less than a third. So put another way, at the moment, you can have your cake and eat it by arguing, or by saying that a dwelling can be disregarded for the purpose of the higher rates because it's subsidiary, because it's worth less than a third, and it's on the same grounds as the main dwelling, but nevertheless would be respected for the purpose of multiple dwellings relief. And the most likely change is to align those 2 rules and say that if you are disregarding the dwelling because it's subsidiary for the purpose of the surcharge, well, you are also must also disregard it for the purpose of MDR2. So that will have an effect of closing relief claims on annexes going forwards. So will there be a bit of a rush again, as with mixed use, when these changes are published? Will there be renewed appetite to buy houses with annexes or complete the purchase sooner rather than later? It's going to affect the reclaim industry. So the practice of sending unsolicited letters to buyers of properties with annexes will probably stop, because the opportunity to argue that MDR will apply will no longer be there. And that might mean, therefore, that reclaims will be limited to arguing that dwellings shouldn't be taxed as if they were dwellings because they're derelict, and possibly because the price included chattels which shouldn't be subject to SDLT. Don't feel too sad for the reclaim industry, by the way. Okay, let's look at case law. So 4 cases, probably worth your attention, I think. One on ATED, so not strictly SDLT, but it's important nevertheless. One on partnerships, which is very topical. One on MDR, and one on land transaction tax, which isn't SDLT. It's the Welsh equivalent of SDLT, but it's important to understand what that case is about, because it highlights the equivalent rule on SDLT. Okay, let's look at Priory first and Jocoguma. So this probably brings to an end a debate about whether ATED daily penalties are valid. Now, to recap, if a company or other type of non-natural person, so a partnership with a corporate member or a unit trust scheme or collective investment scheme, I should say, so where a company partnership with a corporate member or collective investment scheme buy a dwelling worth more than 500,000, then they will be in the scope of ATED. Now, ATED reliefs are available where the relevant buyer uses the building for a qualifying business purpose. So in many cases, ATED is just not an issue. There's no ATED to pay, but nevertheless, the relief has to be claimed and an ATED return needs to be made. So regardless of whether ATED is payable, in every occasion or on every occasion that a company buys a dwelling worth more than 500,000, ATED returns must be made. Now, initially, the penalty for filing an ATED return late is only £100. So if you file within the first 3 months, it's only 100 fixed penalty. Then after 3 months, there's the possibility of incurring a £10 per day penalty for a maximum of 90 days. So that's a further £900. And then there are further penalties for a minimum of 300, which are tax geared. So if tax is payable, these will be ratcheted against the amount of tax payable. And even if no tax is payable, the minimum would be £300 at 6 months and 12 months. So if you add up all those together, the maximum late filing penalty per year for each return is 1,600, which can come as a nasty surprise, particularly if no ATED is payable. But this case, or these cases, they're joint cases, refer to the daily penalties, those £10 per day for 90-day penalties. And the issue is that HMRC must issue a notice and specify in that notice the date from which the daily penalty was payable. In other words, these penalties are designed to incentivize compliance. They act as a warning, effectively. That's the intention, by saying if you don't submit a return, then these daily filing penalties will be payable. But the question is, can HMRC specify a date in the notice that's before the date of the notice? In other words, can they issue these notices retrospectively? Now, in 5 prior first-tier tribunal decisions and 2 equivalent land and buildings transaction tax appeals, the tribunal found that the revenue cannot specify a date that is before the date of the notice. In another, though, the tribunal found that they could. So the revenue appealed the one that they lost, or one of the ones that they lost, and the taxpayer appealed the one that they lost. So both sides appealed in joint cases to the upper tribunal, the equivalent of the High Courts, to get to a final decision in relation to this problem. And the problem really works both ways. In other words, there's an issue with the appellant or the HMRC's argument, because how can the appellant be encouraged to file a return if it isn't aware of its obligation to file a return because it hasn't received a prior notice? So already there's sympathy from the appellant's perspective. But then if you look at it from HMRC's perspective, well, how can they issue a prior notice if they're not aware of the appellant being within the tax? Because unlike income tax, the revenue don't issue a notice, or they're not aware of the appellant being within the tax. So there are issues both ways. There's a lacuna, or a problem, if you like, with both sets of arguments. And without rehearsing all the relevant arguments, legal arguments made, and the merits of both of them, or my subjective view of what the merits are, the tribunal found that they can be issued in the past. So therefore, daily penalties are valid, even though they have retrospective effect. Now, I stress that that may not seem fair, and I sympathise with that. And there has been a practice over the last certainly 6 months to a year of people appealing daily penalties worth £900 pending resolution of this issue, and that has now ended. So unless, which I'm not aware of, the taxpayer is intending to appeal this decision to the Court of Appeal, then this is the final decision. And unless there is a further decision, which would be odd because this effectively would be binding, it has precedent value, then daily penalties in relation to ATED cannot be appealed on the basis that the specified date predates the notice. Okay, let's look at SC Properties Limited. So this relates to a husband and wife having bought a property that included a barn that needed developing, sold it to their company. And they sold it in pursuance of an option that they had granted to the company for what turned out to be a low strike price. So they sold it to their company for $830,000, when actually the property was worth at that stage 1.6 million. And the CGT that would have been payable by the husband and wife on their disposal would have been deferred, and the SDLT that would have been payable by the company would have been relieved, in effect, if the disposal was made by a partnership. So from the perspective of both taxes, it was necessary to understand whether the husband and wife held that property and disposed of it in the course of a partnership, an informal 1890 Act general partnership. And in contrast to some of the arguments I see being made regularly, that joint ownership effectively always counts as a type of general partnership, in contrast to that, the tribunal found that no, there was no partnership. The appellants had failed to discharge to the civil standard the burden of proof that there had been a partnership. And that's because there was no partnership agreement. There was some evidence of partnership accounts and tax returns having been submitted as if there had been a partnership, but the tribunal found that they were self-serving documents. And the crucial thing was that there was no evidence from the wife in this case that she intended to run this business in conjunction with her husband in common, as if there were a partnership. But also, there was evidence that the partnership never intended to make a profit, which was also a particularly striking factor of this. So no partnership, so therefore no CGT, I think it's incorporation relief, and no SDLT relief, if you like, for transactions between partnerships and related parties or connected persons. So really important, therefore, when you're looking at whether joint ownership constitutes a partnership to really stress test the facts and don't make any false assumptions about the existence of a partnership. Okay, Alex Dower. It wouldn't be an SDLT update on case law without an MDR case. And this is no exception. So this is your MDR case for this update. It was actually a stronger case than many that preceded it. So it was an appeal by the taxpayer against the revenue's rejection of MDR on an annex. The annex was large at 50 square meters, described as a self-contained private apartment on Airbnb, had been used therefore as if it were a self-contained flat by third-party tenants, albeit in the context of Airbnb, had its own front door, had its own connection to utilities, as well as its own boiler and heating system. And there were some microwave or some kitchen facilities, albeit they were very limited. But importantly, the appellants tried to argue that it was suitable for use as a dwelling because they in fact had lived there as a self-contained dwelling when they renovated the main house. But the claim was refused by the tribunal. One, because the annex, or the situation of the annex, compromised the privacy and security, particularly the privacy of the main house occupants. There was a planning condition, perhaps for the first time in these types of cases, where the annex received permission to be constructed. I think it was on top of a garage, subject to the condition that it would only be used as ancillary accommodation in connection with the occupation of the main house as a single dwelling. So it couldn't be sold or let independently, and presumably its use as Airbnb was in contravention of that planning condition. It was also refused because it didn't have a proper kitchen, there was no council tax or postal address. But the main thing to draw out from this case is the fact that prior to this, it was clear that suitability for use as a single dwelling had to be assessed objectively. In other words, without presupposing some kind of trusted relationship between the two sets of occupants, it had to be an objective standard or tested objectively in terms of the physical factors. But here they introduced a slightly different concept, which is that not only must it be tested objectively by reference to physical factors, but also those factors must be assessed as if there had been a degree of settled permanence in the occupation. So it's not enough that an annex can be suitable for use objectively in the context of short-term temporary occupation like an Airbnb, but it must be tested as if a third-party occupant intended to stay there indefinitely. And the absence of proper kitchen facilities really weighed against it in this particular case. Okay, let's look at Carl James. So this is an LTT, Welsh SDLT case, but it resonates because the rules in this area are equivalent to SDLT. So the appellant, Mr. James, bought the house next to his, and the two houses and another were in fact originally one house before they were separated and occupied independently. But at the completion date, an access point apparently had been opened up between the two parts, and the kitchen in the purchase flat, or the purchase house, I should say, had been removed by the seller. I think he intended to take it with him to his new place. And then after completion, of course, the appellant decided to combine them into one single house. Now, the appellant argued that the higher rates for LTT didn't apply because there is an exception where the buyer has a prior interest in the purchased dwelling. Well, clearly he didn't. He didn't own any part of the dwelling that he was buying before he bought it. And he tried to argue that the exception for replacing his main residence also applied. But here there's a problem because he didn't dispose of his old main residence, and he didn't intend to stay in the purchased property as his main residence. In other words, he intended to stay in part of the purchased property in the context of a combined main residence, a combined house. So this reinstates or supports the earlier tribunal case for SDLT, Murreth, where effectively the same facts existed. So where you act for someone that buys an adjoining property, maybe a flat above, a lateral flat, a house next door, with the intention of combining them, do warn of the almost certain answer, which is that the higher rates will apply because they're buying a house or a separate flat. And the higher rates will not be reclaimed, or they cannot be reclaimed, because there is not likely to be a disposal of their last main residence, because they intend to keep it and use it in combination with the purchase house. The tribunal said something a bit curious, which is that the purchase dwelling was a dwelling, even though it didn't have a kitchen. I'm not sure if it went too far there, but you can see, the tribunal was showing sympathy with the revenue, that it was still a dwelling, even though the seller, removed the kitchen, imminently before the completion date. And what this case does, I think, is illustrate the danger of making false assumptions, reasonable false assumptions on how SDLT works and how LTT works on the higher rates and the replacement main residence test in particular. Okay. Let's look at Homes for Ukraine relief. This won't take long. So, earlier this year, can't remember when exactly, I think it was late spring this year, the government announced their commitment to helping companies and other non-natural persons make available their dwellings that they own or buy for the purpose of the Homes for Ukraine scheme. And we have draft legislation. It was published a couple of months ago, hasn't yet been enacted, but it will be enacted with retroactive effect. So the SDLT relief or reliefs will be extended, backdated to the end of March this year, and the new ATED relief will be backdated to the start of the ATED chargeable period, which is the 1st of April this year. So for the SDLT reliefs, remember that these are reliefs not from SDLT entirely. These are reliefs from the flat super rate, as I call it, the flat 15% penal rate or anti-enveloping rate that's payable by companies when they buy a dwelling worth more than 500,000, except for qualifying business purposes. Now, the existing SDLT reliefs for, let's say, letting, trading, developing, will be extended insofar as any intention of the company to permit a Ukrainian refugee to occupy the dwelling after completion under the Homes for Ukraine scheme will be ignored. So it's okay if the company has a dual intention or an exclusive intention to permit a Ukrainian refugee, except one that is otherwise connected with the company, to occupy the dwelling temporarily. And similarly, ATED relief will be introduced for the first time for the period that the dwelling is occupied or reasonable steps are being taken to start occupation by a Ukrainian refugee, if an existing ATED relief was available before the relevant period. So if the company had let the property, had owned the property in the context of trading it or developing it, and then switched to making it available or starting to take reasonable steps to make it available for the Homes for Ukraine scheme, then ATED relief will be available for that period. If relief was not available before, then this new relief only kicks in when there is real occupation under the scheme once that begins. Okay, drawing to an end, let's just look at a couple of things which I've seen recently. One is probably maybe loose marketing speak, but nevertheless does illustrate the point that arguments that dwellings can be taxed as if they were not dwellings, in other words, not residential property because they are not suitable for use. Well, you really need to show to a high standard that dwellings are not suitable for use on the completion date. And if, as was being said by a particular promoter, if dwellings have mold on walls, so there's a temporary reason which can be addressed very quickly and easily, damp in other words, to prevent them from being occupied immediately, well, that's probably not enough in my view. You really need to show some objective reason why it's unsafe to stay in that property immediately at completion without addressing that problem with, you know, an insignificant amount of money. So you really need structural defects, in my view, or some kind of hazardous material that, you know, needs removing. As I say, mold might meet the relevant standard, but I think it's unlikely. Then I saw a particular point, which is that probate relief is a complete relief, where someone buys a property from a deceased individual or the personal representatives of a deceased individual, provided that they, this is a company that is, provided that the company doesn't intend to spend more than the permitted amount to develop the property. And in this particular case, I think the developer intended to demolish and rebuild the particular property, which obviously would have breached the cap on permitted spend. But the argument was, well, a company would buy the property from the personal representatives, then put it on the market for a month to see if it would sell, presumably at the same price. And if it didn't sell, then they would sell it themselves to a group company that would then carry out the development of the property. And that for me is very close to being vulnerable to a whole host of anti-avoidance rules. So be careful about probate relief. There is a restriction on that relief where there is an intention to spend more than the permitted amount, which ultimately is 20k, but in some cases can be even lower than 20k. And then the last one is the too good to be true argument that a flat in a block with a communal gym is a mixed use transaction and therefore avails of the lower non-residential and mixed rates of SDLT merely because the owner of the flat acquires some kind of interest to access that communal gym. A similar argument was made in relation to a communal garden, and the tribunal found completely convincingly that the argument was unsuccessful in its attempt to engage the mixed use rates. So be careful that flats with communal gyms, restaurants, gardens, whatever they might be, I suppose for the most part they will be in central London. Be careful that they are where someone says that they're a mixed use transaction. If it feels and smells too good to be true, probably is. Okay, Haifa, I think, yes, it is. That's the end of what I wanted to cover. And do we have any questions?
Yes, we do. So thank you for your presentation. We had a few questions from the audience. One of the questions is, a client owns a buy-to-let property but lives at a house with his mother. His mother passes away and the house is left to the client and his siblings. The client wants to buy out his siblings. Will the exemption apply as he already has an interest before buying the siblings out?
Well, yes. So basically, when you look at the higher rates, you need to determine whether someone is buying an interest in a dwelling worth more than 40,000, and at the end of the completion date, that buyer owns another, similar interest, an interest in another dwelling worth more than 40,000. In this case, I think from that description, the buyer owned and would continue to own their main residence. And there is an exemption for properties which are inherited, but that exemption applies to disregard the inherited dwelling as the other dwelling. And that's not the case here. So there is an exemption for acquiring dwellings or other property from personal representatives in pursuance of your rights as a beneficiary. But in this case, that's not happening either, because I think from recollection, they're buying out their siblings' interests. So on the face of it, I can't see a reason why there wouldn't be SDLT applied at the higher rates on the buyer's acquisition of his siblings' interests in the inherited dwelling, provided that that person continues to own their main residence at the end of the completion date.
Okay, thank you. Another question we have here is, a client currently lives in a rented place. He is buying a buy-to-let investment, but this is a first property. Will this be treated as a first property or buy-to-let? Sorry.
Yeah, okay, perfect. So that's a really good question. It's one that we see a lot, and it does throw into stark focus some false assumptions. It's a good question, because intuitively you think that because the surcharge is designed to discourage people buying second homes and buy-to-lets, that the purchase of the first property of that description would engage the surcharge, and it doesn't. In fact, the intention to occupy the purchased property or not actually doesn't feature in the conditions for the higher rates. What features is whether the person will own at the end of the completion date another dwelling. And so the mere fact that the buyer intends to rent out the purchased property doesn't engage the higher rates. If they're only renting and don't own anything else, and they're not married or in a civil partnership with someone that does, then they won't pass the relevant condition, which is condition C in the legislation. They won't own another dwelling at the end of the completion date. So their intention to occupy the purchase, or the lack of intention to occupy the purchased property, is completely irrelevant. They won't be able to get first-time buyer relief because it is a condition of that relief that they intend to occupy the dwelling. But if the price is more than 500,000, they won't get that relief in any case. So standard rates transaction, not higher rates, even though they intend to exploit the property as a rental property.
Okay, thank you. The next question is, would a prohibition order issued by local council based on the condition of the property on day of completion be strong enough to change a previously residential property to non-residential due to being unsuitable as a dwelling on day of completion?
Well, without knowing what the reason for the prohibition order is, it's difficult to say definitively, but it's pretty encouraging, if you want to argue that it's mixed use or non-residential, I should say, that, if the council has issued something to prevent it being occupied, because presumably it's objectively dangerous to occupy it, then that would seem to suggest that it would meet the relevant standard. So that's one where, although you can't be definitive, it's definitely worth pulling more facts to understand the quality of the argument that it's non-residential.
Okay. This one I think is based on the answer to the last question. So if the client's spouse owns a property, do they have to pay higher rate tax even if they have never owned a property themselves?
Yes. So marriage hurts buyers in this context. So if the buyer is buying in their sole name, the mere fact that they're married or in a civil partnership with someone that owns another dwelling means that on the face of it, the higher rates will apply. They're treated effectively as one economic unit. You have to assume that the spouse of the buyer is actually buying, even though they're not, because they're married. And I have seen probably on 3 occasions where people have sadly, you know, married at the wrong time, such that their joint purchase or one of their purchases of their new home together has meant that the surcharge is payable, when had they married afterwards, after the completion date of their purchase, the higher rates wouldn't have applied. I think some wag wrote an article called Stamp Duty Love Tax, SDLT, which I think illustrates this pretty well.
And following on from that question, so boyfriend, girlfriend, is that okay? Transferring a property to a girlfriend to avoid paying higher rates on new purchase?
Okay, so I imagine what's happening is the buyer intends to buy in their sole name, and they own something already, and so therefore what they're probably thinking of doing is transferring the property that they own at the moment to their partner, their girlfriend, boyfriend, before the completion date, leaving the buyer free to buy the new property, possibly their new main residence. And because they're not married, then you look solely at the circumstances of the buyer. And because the buyer wouldn't own anything at that stage, because they've disposed of it to their girlfriend or boyfriend, then yes, the surcharge wouldn't apply in those circumstances. I think there's a danger, though, that so in some cases, these types of arrangements could be vulnerable to anti-avoidance, particularly if there's an intention to reverse that gift or that transfer. So if the buyer transfers their property to their girlfriend before the completion date as part of an arrangement for that person to transfer it back to them after the completion date, well, then clearly, viewed realistically, that looks pretty bad. It looks as if they never actually disposed of their house in the first place.
Okay. And the last question I think we have is, could you give some more information on time limits for amendments to SDLT ones? And could a SDLT submitted within the last 4 years be amended?
Okay, so I think the question talks to reclaims. And so regardless of the context, an extra amount of SDLT has been paid, and they want to recover that SDLT. And that might be because they wrongly classified the property as residential when it was mixed use, or they classified it as residential when it was so derelict it was non-residential, or they failed to claim MDR. And the reason for overpaying is important. So if they overpaid because they failed to claim a relief, like multiple dwellings relief, then the application for a repayment can only be made within 1 year of the filing date. And the filing date is almost always the completion date plus 14 days. So generally 1 year. If the reason for having overpaid SDLT is because of some other reason, not because they failed to claim a relief, but because they classified the property incorrectly, like a mixed use transaction, then they would have 4 years from the completion date. That 4 year in time reclaim process, though, is subject to meeting other conditions. And in particular, there are various instances where the revenue are not liable to give effect to that reclaim. So in principle, a 4 year reclaim window is possible where the overpayment isn't due to failing to claim a relief, but you need to check whether the exceptions to that reclaim process are applicable.
Okay. Yes, thank you so much for answering that question. I'm afraid that's all the questions we have time for today. I would like to say a big thank you to Sean for joining us today. I hope you all found this session helpful and informative. If you have any other questions about anything you've learned today, then please either contact us by telephone on 0207 186 8090, or reach out to your account manager who will be able to assist you. This session is being recorded and we will send you a copy so you can refer back to it. All that's left to say now is thank you so much for joining us, and we hope you have a lovely rest of your day. Thank you.
Thank you.